The first quarter GDP results from China and the United States contain some oddities of inventory behavior which are likely to produce a relatively slow world economy in the middle quarters of this year, with the recovery we are expecting largely postponed to the end of the year. The key point about the trade war threat last year from the standpoint of the rest of the world was that there was a large increase of import costs and a large decrease of export competitiveness arising from the fact the dollar went up and the yuan went down. But when it comes to the US and China themselves, the main point was that in the second half of last year, the Americans brought in as much as they possibly could to Long Beach in order to be able to forestall the imposition of tariffs that were threatened for most of the second half of last year. And the result was, of course, that there was a build-up of inventory in the United States and a rundown of inventory in China. But interestingly, in the first quarter of this year, the rundown of inventory in China continued, and it looks as if Chinese business is in a rather more permanent way becoming more competitive in terms of its capital productivity and inventory behavior. And as a result, the imports were heavily down in recent months, much more so even than exports, as the exports to the United States fell off. And therefore, the net exports were the main source of growth in China in the first quarter. And in fact, over the fourth quarter of last year and the first quarter of this year, there was effectively no gain at all in real domestic demand in China on our recalculations of GDP. And that means that the recovery is likely to be postponed into the second half as some of the factors depressing demand continue to play themselves out. When it comes to the United States, the inventory building in the first quarter was spectacular, in spite of the fact that the imports from China fell off very sharply, and imports therefore also, through falling off, contributed substantially to the 3.2% annualized growth rate in the first quarter. And the basic point here is that if inventory behavior now returns to something like the long-run average, the growth rate of the rest of the economy in the United States, mostly final demand, needs to be at least 1.6, 1.7% annual rate just to offset the negative impact that that sort of inventory change would have. On top of which, of course, we have a possible return to more normal patterns of importation. So the result is that it's highly possible that there is a negative quarter in either the second or the third quarters of this year, and it'll be the end of the year before the recovery really starts, before which we expect to have seen a rate cut from the Fed.